Okay, why don't we go ahead and get started with our webinar today. Um, Aloha and hafadai to each of you attending from Hawaii, Guam, or the mainland. My name is Al Ogata, and I'm the president and CEO of CyberHawaii. CyberHawaii is a nonprofit information sharing and workforce development organization that focuses on improving cyber resiliency in Hawaii's small and mid-sized businesses, as well as within the community as a whole. We're supported by the state of Hawaii, the University of Hawaii, private sector businesses, and through partnerships with numerous agencies in Hawaii. It's my pleasure to welcome you today to our webinar that focuses on cyber insurance. And you may have seen the title slide that said radically complex. And I think that's a tagline that our speaker is going to address during the presentation, which I think will be of quite a bit of interest to folks here. So the webinar is brought to you through a grant from the Hawaii Department of Business, Economic Development, and Tourism, and is supported by the Chamber of Commerce Hawaii and the Hawaii Defense Alliance. While most security presentations do not talk about cyber insurance, the fact is that it has an important place in the cybersecurity framework. The NIST cybersecurity framework is one of the most widely followed and calls out distinct control areas from identify, protect, detect, respond, and recover. Governance controls were most recently added that address risk management strategy and policies. Cyber insurance fits into the recovery control section and focuses on things like providing resources to aid in recovery, data and identity recovery services, and preparations needed to recover. A business must have a basic level of cybersecurity controls in order to qualify to obtain a cyber insurance policy. Questions for today's webinar should be entered into the chat window and will be read at pauses in the presentation. This presentation is also being recorded, and the recording will be available on the CyberHawaii website in a few days. During this presentation, you're requested to remain on mute unless asking questions during designated Q&A sections. So with that, your presenters today are Tammy Yamada from Pyramid Insurance, a local full-service insurance agency, and Mark Smith of CRC Insurance, a wholesale and specialty insurance broker. At this point, I'd like to turn the session over to Tammy to move us forward.
Hi, good afternoon, everyone, and thank you for joining us. I'm Tammy Yamada, Vice President of our commercial division for Pyramid Insurance. I would like to introduce you to our special guest speaker today, Mark Smith, a great friend and colleague of over 15 years. Mark is a cyber-focused insurance wholesaler, specializing in cyber since it's emerged to prominence in 2007. As head of CRC's national cyber team, he works closely with many cyber insurers in developing and refining of cyber policy forms and endorsements. He is a frequent industry speaker, writer, and educator on all things cyber. He is a graduate of Washington State University and splits his time between Arizona and Wisconsin with his Labradoodles, Roca and Snickers. Mark, now I turn it over to you. Mark, you're on mute.
Excuse me. Hi, I'm very happy to be with you. I send greetings from Wickenburg, Arizona, the team roping capital of the United States, which is about an hour and a half outside of Phoenix. And I'm really excited to talk to you today about cyber insurance. And cyber insurance is really radically complex insurance. Why? It's simple. Because no other insurance product has so many moving parts. Depending on how you count, there are potentially up to 22 different coverages found in a single policy that respond to cybercrime losses. Uniquely, a cyber event triggering coverage under one insuring agreement may spiral and simultaneously trigger other insuring agreements. As an illustration, think of a bowling alley. One throw of the ball strikes one pin, and it topples over, hitting another, and then another, until half or all are down, unless you're an awful bowler like me. It's often just like this with cyber claims. One cyber event and half or more of the coverages can be activated. To better understand cyber insurance, today's presentation will be examining the insuring agreements, each of which are best understood by looking at specific claim examples. We will consider several reasons businesses should purchase cyber insurance, focusing on loss facts, claim costs, loss prevention, and mitigation measures provided by insurers. Then, how to obtain the coverage, and finally, I think this is very important, what to expect when filing a claim. Now, let's move to the next slide, please.
Sorry, I'm getting a little latency here.
That's fine. Okay, I'll go on. All cyber carriers have structured their policies into essentially two groups or sections. The first is for third-party claims, which allege harm arising from a wrongful act of an insured in securing, storing, or processing third-party data in their possession, or by a third-party vendor servicing data on their behalf. The second group is for first-party losses, indemnifying the insured for their own expenses or income loss arising from a cyber event, as well as the option of cybercrime coverage for actual theft of an insured's funds or funds they hold in escrow for others. There are 5 third-party insuring agreements in a cyber policy. The first 2 are network security and privacy liability, which are similar but different. As an example of a network security claim, consider a hacker who has exploited a vulnerability in an insured's computer system, such as weak remote desktop protocol or port, resulting in a data breach evidenced by hacker gaining access to personal identifiable information of the insured's customers, such as credit card, social security, passport, or driver's license numbers. Essentially, any personal information that is not available to the public and is protected under either federal or state laws. Affected individuals could bring suit for the thievery of their personal information if they became a victim of identity theft, asserting the insured did not adequately protect their network from attack by eliminating the vulnerability. In addition, the information access might involve corporate confidential information held under a non-disclosure agreement. For instance, if the insured is a law firm, it could hold highly confidential merger and acquisition information, which, if disclosed by a cyber criminal, could blow up a deal, devastating the law firm's client. Privacy liability arises out of the unauthorized access or distribution or disclosure of personal identifiable information, very importantly, in either paper or in electronic format, as defined by state and federal privacy laws. This also includes patient healthcare information protected by HIPAA. A typical claim does not arise out of network security failure, but what I call an oops. This could involve a lost, unencrypted laptop with personal information. Believe me, that's happened so many times. Or the theft of unshredded documents set outside, ready to be destroyed. Or, for example, a doctor sent patient healthcare records to the wrong patient who has a similar name. Do you have any idea how many different Mark Smiths there are out there? I've had my information sent the wrong place several times. An accounting firm mailed important tax documents to the wrong clients when a mail clerk mixed up envelopes in the mailroom. Or an attorney, when riding home on a ferry, left a briefcase behind on the seat containing client files. Any of the affected parties could bring a claim for damages from the unauthorized disclosure of their confidential or personal information. None of these claims involved a lack of network security, but a mistake made by employees in handling information. Regulatory defense and fines and penalties is an additional third-party coverage. All 50 states, various branches of the federal government, and even the European Union have data privacy laws, including the requirement to protect personal identifiable data, often by encryption, as well as to supply prompt notice to affected individuals after the discovery of a data breach. If such notice is not provided on a timely basis as specified by law, regulatory authorities may bring suit. For example, a clinic accidentally lost thousands of paper patient records when they moved locations. The clinic, thinking they would eventually be recovered by their moving company, who obviously moved them somewhere, did not want to upset their patients and did nothing. But state and federal authorities became aware of their disappearance, which is a privacy violation under the law, and brought a regulatory claim for failure to secure the records, as well as for the notice violation, resulting in thousands of dollars in fines. I remember many years ago, a delivery truck was moving patient files from a hospital in Spokane, Washington. And the driver forgot to close the back door of the truck, and hundreds and hundreds of patient files went flying in the air as he drove up the South Hill in Spokane for his next pickup. It was all over the evening news. This is obvious a case of a oops, or the whoops. No matter how good any entity's cybersecurity may be, privacy violations can still happen from the most unforeseen circumstances, and the regulatory authorities are always watching. A contractual coverage titled Payment Card Industry Data Security Standards, that's a mouthful, we call it PCI DSS, covers fines and penalties and assessments. This is a form of third-party coverage found in cyber policies. A hotel group learned from their acquiring bank, who processed their credit card transactions, their point-of-sale machine terminals were compromised, and all credit card transactions for the week had somehow been skimmed by hackers who sold the stolen card data on the dark web. The Payment Card Industry Organization determined the hotel's point-of-sale system was the source of the theft and found, after an investigation, the hotel was not PCI DSS, Data Security Standard compliant, at the time of the event, a contractual violation of the card processing agreement, and as a result, the acquiring bank imposed contractually authorized fines and penalties and assessments to recover the fraudulent use of the cards and cost of their replacement to the tune of $270,000. The hotel was able to negotiate repayment over the course of 2 years out of their merchant account. This also happened to a small sporting goods store in Eugene, Oregon a few years back, which had to repay $50,000 in assessments. Now, these claims are not as common now due to the new chip and pin technology found in the cards, but they still do occur. The final third-party coverage included in the policy is media liability, which is very odd, as media liability does not involve any cybercrime theft, except the theft of intellectual property, which lends credence to why I call cyber radically complex insurance. This covers media wrongful acts by or on behalf of the named insured, typically defined as the immediate perils of libel, slander, defamation, copyright and trademark infringement, product disparagement, and plagiarism, to name a few, arising from the insured's media content, which may include websites, advertisements, blogs, social media posts, as well as any printed media, such things like brochures or posters. An example was a suit against an architectural firm who included a picture of their downtown office building on their website. Sounds reasonable, right? Another architectural firm who designed the building alleged the use of the photo of the building they designed was a violation of their architectural copyright, as they argued the image on the website implied the insured had designed the building, which I guess was very famous in the city they were in. They sued for damages and won almost $1 million. Okay, as I said before in my bowling pin analogy, it is very possible a single data breach may involve more than one of these third-party coverages. For example, in the skimming attack in the hotel mentioned earlier, it could trigger a third-party network security claim by credit card holders who found fraudulent activity in their cards resulted in damage to their credit scores, including loan denials, or a regulatory claim if the hotel failed to notify affected cardholders, in addition to the PCI DSS claim which occurred. Okay, let's look now at first-party loss coverages. These insuring agreements indemnify the insured for expenses paid to respond to a data breach, the payment of an extortion demand, a loss of income, or the loss of money. Breach response coverage supplies payment for expenses incurred in a suspected data breach. For example, if a firm believes it has been penetrated by a hacker, the insured will reach out to their insurer, who will engage a forensic investigation firm to determine how it happened and what, if any, data had been affected. This can be very costly. Okay, a number of years ago in Montana, a technology firm who was breached spent over $500,000 alone on a forensic investigation and never did determine the source of their attack. Once the forensic firm determines what data has been compromised or stolen, this information in turn is supplied back to an attorney to evaluate the data and decide if a state or federal breach law requires notice. Not all situations like this do require notice. So the attorney has to make this determination to see if they have to notify these affected individuals. Now, keep in mind, the lawyer must look at the residency of each affected individual and evaluate their home state's data breach laws to determine if notice is required. If yes, then the law firm drafts the notification documents particular to the state in which each affected person resides. These notices will then be sent to a fulfillment firm for printing and mailing, a call center set up to handle inquiries by affected individuals after receipt of the notice, and credit monitoring may be offered to each affected person depending on the data compromised. Wow, a lot going on, right? And finally, a public relations firm will be hired to engage with the press to protect the insured's reputation. Basically, you're hiring a spin doctor. All this is extremely expensive. It is especially expensive if the entity does not have cyber insurance and must engage on the fly individual vendors or lawyers to provide these services on an emergency basis. They can charge sky-high rates, much higher than what they charge insurance companies who have negotiated the rates downward, as the entity has no choice but to respond to the breach quickly. In the case of a ransomware claim, which I think we're all familiar with, hackers either encrypt or exfiltrate the insured's data, lock down the insured's computer network, or do all three. Why not? They will make a ransom demand of Bitcoin before providing the encryption keys to unlock the insured's data or network. If the ransom is not paid, they will destroy the data, sell, or make it public. Now, the latter two are known as double extortion, if you've ever heard this in the trade press. Even worse, they may extort any individuals whose data they have stolen from the insured, which is known as triple extortion. Now, the breach response coverage I mentioned earlier will pay the cost for forensics to determine the affected data and how it was attacked. But the extortion coverage will indemnify the insured for any ransom payment made to the criminals, as well as expenses incurred in negotiating and securing the Bitcoin payment. The decision whether to pay the criminals their extortion demand is a very tough one. It is best mitigated by having encrypted offline backups routinely evaluated, but even these can sometimes be corrupted or incompletely backed up. Now, unfortunately, even if the ransom is paid, many victims do not always get all their data back, if at all. Now, it's certainly good business practices for cyber criminals to give their data back because they want to do this again and again. And if they don't give the data back, then it starts to become well known within the industry of the insurance company and says, well, don't pay them because they won't pay you back. But so anyway, they track all that. But going forward, if the criminals exfiltrate the insured's data and threaten to sell or make it public, this is an extraordinarily strong incentive to pay the ransom and protect the stolen data. When the data is exfiltrated, this is normally considered a data breach, and the breach response process I have mentioned commences. So think back to that. Now, in the event the hackers damage or destroy the insured's electronic data or computer systems, or if the insured elects not to pay the ransom and later finds that it's impossible to restore their data from backups, data and systems restoration coverage will pay the cost to restore, repair, or maybe even recreate the affected electronic data or software systems. Now, this may be as simple as paying IT experts to help restore the data from backups, or as complicated as paying the insured the cost to recreate the damaged or destroyed data. For example, an architectural and engineering firm fell victim to a ransomware attack when all their data was encrypted. They decided not to pay the ransom. Instead, they thought they would download their cloud-based backups. Unfortunately, and you know where this is going, all their backups failed, which is not particularly uncommon. I know several stories like this. It was discovered that they had not assessed the effectiveness of their backup process before the attack. Basically, they never tested their backups to make sure they were fully backing up. So the firm paid out $20,000, well, at least their insurance company did, for forensics, which, as I mentioned, are part of the breach response costs, and then over $270,000, basically to pay their engineers on staff to recreate the data that they had lost, vital to continuing their business and meet their contractual requirements, because a lot of this stuff was absolutely critical. Now, if the cyber attack had been so extreme that the insured's computer hardware itself was damaged, which at times this has certainly happened, and I know some laptops can be very vulnerable to this, and the cost to repair the hardware exceeded the cost of replacement, bricking, what we call bricking coverage. The reason we call it bricking is because that hardware is as useful as a brick, would kick in to replace damaged hardware. I think sometimes this is one of the few areas where insurance companies seem to have a bit of a sense of humor. Okay, now business income exposures can be covered as well. Business interruption coverage will pay for the loss of income and extra expenses if a loss is a result of a network security failure. For example, a restaurant whose point of sale system was shut down by a malware or denial of service attack could only accept cash. So they lost significant income until their system was restored, as they could not accept credit cards. And frankly, how many of us go to the restaurant with enough cash to pay for a nice dinner? I know I don't. So cyber business interruption will pay for this type of income loss for up to either 180 to 360 days, depending on what the insurance carriers will offer. And this is known as the period of restoration, or until the system is fully restored if earlier. After the insured provides proof of loss. So essentially, okay, the system's down, they got to get it back up and running, okay? And once it gets up and running, then the person that's been affected then works and puts together a proof of loss saying, here's how much money and extra expense we incurred. Now, there's normally an hourly waiting period before the coverage kicks in, anywhere from 6 to 12 hours, depending on the insurance company. Now, the business income coverage is often modified to include what we call systems failure coverage, which is not related to network security failure. It's much different. It's an unplanned, unintentional, or unexpected shutdown of a computer system resulting in loss of income. Now, this could arise from a software installation gone haywire, which is kind of one of those oops, right? Hardware failure, hardware just didn't work properly, or an accident. It does not, however, include a shutdown due to power failure or an interruption of the internet itself. Now, these policies may also include dependent business interruption or dependent systems failure for losses arising out of a security failure or unplanned system interruption of an IT vendor, like a managed services provider or a point of sale vendor or an application services provider, or other business services providers like an accounting firm, a fulfillment or payroll firm. Some carriers even expand their coverage to apply to a supply chain partner, which provides products or services to the insured under a written contract. Now, this last point is very important. There must be a written contract with the vendor or the supply chain partner, or coverage will not apply. In a recent claim, a Midwestern title company used an application services provider to host their network and all online applications and underwriting platforms. The ASP suffered a ransomware attack. Now, how that actually occurred, we don't know. They didn't want to talk about it. And it shut down all customer platforms, as well as the destruction of customer records, as their backups were found to be corrupted in the attack. Now, sounds kind of like the A&E firm I talked about earlier. Now, the title company lost over $1 million in revenue, as well as extra expenses incurred, as they had to scramble and find new software to relaunch their underwriting platform, which took them 5 months. And I know about this because I actually insured this company. Now, had the ASP experienced an unplanned interruption of their network instead of a ransomware attack, that other coverage, dependent systems failure, would have kicked in. Now, there's one more form of business interruption coverage. See, they just keep coming. This, again, radically complex. And this is included in the policies and is well known as reputational harm. Now, in the event of an adverse public media report of cyber extortion, data breach, or security failure affecting an insured client, the policy will pay the net profit after taxes that would have been earned had such a report not been made. A typical waiting period of 2 weeks after the report applies. So the coverage doesn't come into play until like 2 weeks have passed. And the policy provides an indemnity period of between 60 days on the low end, all the way up to 360 days, depending on the policy form. Now, this coverage recognizes the immediate loss of trust of clients after a cyber attack involving their data goes public. Yeah, who wouldn't lose trust, right? For example, and this is a really great example, a law firm was a victim of a network security attack in which an attorney opened a phishing email allowing cyber criminals to access and steal client data. The media made the attack public, and several of the law firm's clients terminated their relationship, leading to a loss of income during the period of indemnity. Basically, they canceled their retainers, or they went elsewhere during this time period. So very significant. And there have been a number of firms that have gone bankrupt following such public reports after losing most of their clients. Cyber policies offer several individual crime coverages typically purchased on a commercial crime policy. This means there may be a coverage overlap for those insureds already buying crime. These are often written at a sublimit of between $100,000 to $250,000, and sometimes can be negotiated higher. Now, I'm going to give you a recap of these coverages, which are you're going to see on the screen. So the first one, computer crime. Now, cyber criminals somehow, doesn't matter how, but they penetrate the insured's computer system and they gain access to the insured's online banking application. And what do? They send fraudulent electronic instructions to the insured's bank to transfer money to the criminal's own bank. Funds transfer fraud. Criminals send electronic wire transfer instructions to the insured's financial institution, impersonating the insured, instructing them to wire money to themselves. So they didn't go inside the insured's computer, they did it outside. Social engineering or fraudulent instruction coverage. Now, this is the most common crime loss businesses of all sizes are incurring. The criminals send fraudulent wire transfer instructions by voice, text, or other electronic means to the insured. Here's the key. They're impersonating an insured person or a customer, business partner, or a vendor, instructing the insured to transfer monies or securities. Oftentimes, there's a sense of urgency involved. Like, if we don't get the money right away, we can't close the deal, so you got to do it right now. Or they'll send this request, not typically the people in accounting, they'll send it to like the president of the company and say, hey, this is so-and-so, your number one customer. We don't get this done right away. And so, of course, sometimes the top dog of an organization just calls the accounting, hey, just make this happen. Some of these forms also include, very importantly, funds held in escrow, which could be very important for like title agencies or like law firms sometimes have funds in escrow. So there's a variety of companies that hold funds. And they may also include instructions to transfer tangible property. So don't just send the money to another bank, but actually call up a company like say, hey, that truck of equipment you're supposed to send to our warehouse in Honolulu, well, let's send it over to Maui, to Lahaina, okay, for example. And so they ship the money, the tangible property over there. And of course, the criminals are waiting and take the property. So a few insurance companies extend coverage in this manner. So here's an example. This happened a few years ago. A contractor, thinking it was receiving a request from a construction equipment dealer to change their bank routing instructions on an invoice, fell victim to this fraud and wired a Chinese fraudster $2.5 million, which they could not recover. That's a big one. And actually, the biggest ones have been way bigger than that. In all cases, the best way to deter this fraud is for every organization to implement mandatory callbacks to a predetermined number with the company or person making the change request. So it takes a little forethought here and planning, but that's the best approach. And limit also who can make these requests, probably require two people to have to approve these requests. There's a whole variety of procedures that can basically help eliminate these from occurring. But guess what? Again, the oops factor comes in. Now, invoice manipulation is somewhat new. Now, this coverage wasn't always available, but it covers claims where the criminals penetrate the insured's computer system and view outstanding invoices. Then they impersonate the insured. There we go again, impersonate the insured and send fraudulent instructions to a customer, instructing them of new payment instructions, directing the payments back to themselves. Now, this coverage reimburses the named insured if it cannot collect payment from their customer of an outstanding invoice which was paid to the criminals. So you're going to run into this. Sometimes the customers, yeah, we fell victim to this. It's our fault. We'll pay you because it's really our loss, not yours. But then again, you could argue, well, if they penetrated into the insured's computer system and found all these invoices, that's bad on the insured as well. The next one is telephone hacking. And we don't see this very often, but this reimburses the insured because of a hack of their telephone system for the cost of unauthorized calls made by the perpetrator. So basically long distance calls. And the last one, cryptojacking. Oh, I'm sorry, I have a dog going off here. Oh no, it's an Amazon delivery. It always happens. Okay, we'll keep going. This reimburses the insured for loss resulting from the unauthorized use of the insured's computer system by a third party. And this is what's interesting. It's for the sole purpose of cryptocurrency mining or other computational uses. So basically, they take over the insured's computer system or network, and they slave it to their own network. And so they're using all these different computers, their own, plus everybody they've attacked, for cryptocurrency mining. Some of these are so sophisticated. I was at a seminar once, and they talked about this, like over 500,000 computers around the world were all harnessed to do cryptocurrency mining on off hours when the company was basically shut down. It's really ingenious. Okay, now that we've reviewed the basic content of cyber policy, I have to provide some context. First, there is no standardized insurance policy among the over 75 insurance carriers offering this coverage. Each insurance carrier has drafted their own policy form, many significantly different from each other. Now, the differences lie in the definition of terms or the coverages themselves, policy exclusions, and generally not much in the policy exclusions in the actual policy forms, unless they, it's really if they add them to the policy, which are endorsements. Yes, or the use of endorsements, or some might not offer all the insuring agreements available. Now, for example, some insurers, if they don't like the cybersecurity of a company that they reviewed, may want to restrict extortion payments for a ransomware attack to only $250,000, for example, or apply a much higher deductible for ransomware attacks. I've seen that happen as well. Some will add exclusions for loss involving biometric data, others for loss alleging the wrongful collection of data, often involving pixel or tracking technology. Another example, one insurer's definition of dependent systems failure only applies to the unexpected outage of a computer system of an IT vendor who is hosting a computer network for an insured. Yet, another carrier's same coverage is much broader, applying to any third party who provides a product or service to the insured under a written contract, or what we know as a supply chain partner. For example, for a contractor expecting a shipment of building materials from a supplier who has signed a contract of delivery on a specified date, if the supplier is a victim of a cyber attack, their delivery could be seriously delayed, leading to the contractor's loss of income if the contractor's client reduces payment due to the delay. This is just one example how minor differences in a policy can be significant. Now, it's important to work with like a local retail insurance broker like Pyramid Insurance, who is familiar with these differences and can offer a policy based on the scope of the coverage, not just the lowest price. Okay, now we're going to really switch gears here. Why should a company buy cyber? Obviously, the scope of the cyber policy coverages speak for themselves. These policies are incredibly comprehensive in scope, radically so, as I have said before, providing tremendous protection for the buyer. Secondly, CFC, a major cyber insurer, reported in 2023 that 96% of all cyber attacks were directed at small and medium-sized businesses, noting these firms have less than state-of-the-art cybersecurity, and criminal organizations view them as low-hanging fruit, waiting to be picked off. In their 2023 cybersecurity report, Hiscox Insurance surveyed over 5,000 small businesses and found the following, which I think is interesting. 53% had at least one cyber attack. Now, it didn't say in what period of time, okay? But I'm going to guess in the last 4 or 5 years, probably. And of those with under 10 employees, 36% have been victims. Other loss facts found the number one cause of loss was a social engineering attack or payment diversion arising out of phishing fraud. I think right now we should take a quick pause and review for everyone here today what phishing fraud entails, since this is probably the leading attack vector. So, a criminal sends an email appearing to be authentic from a known source with the intent to persuade the insured to either disclose information, such as a request to update password information, which of course would allow the hacker into the insured's network, click on a link, or download an application which contains either malware or ransomware. Now, the email often conveys a sense of urgency or something to pique interest, like 2024 bonus pool information or urgent HR complaint filed today. Please respond immediately. Okay? Now, no. This study is old, but it still rings true, I believe. In one study, it was reported 23% of all employees opened a phishing email. So that tells you that these email, they're like, they're going out to small businesses. Some of them are just so sophisticated now with the advent of AI. It's not hard to understand why people fall victims. Now, normally the phishing email addresses will be off by one letter. So instead of msmith at CRC Group, it may be M.A. Smith at CRC Group. Every organization should require ongoing anti-phishing training, including ongoing simulated phishing attacks, testing employees at all levels of an organization. My company basically phishes us internally in these simulated attacks every single month. And guess yours truly has succumbed as well, at least one occasion. And I'm not proud of it, but it was at least I clicked on the link and our company said, "You have been phished." And I was like, oh no. Oh well, moving on. Hitchcock's found the second leading cause of loss was a ransomware attack predicated by a successful phishing attack. 1 in 5 surveyed had experienced such an attack, and less than half recovered all their data after paying the ransom. Now, another reason to purchase cyber insurance are the claims cost. So what do these look like? Well, there's no nationalized, centralized aggregator of cyber claims statistics. However, the reports offered by the cyber carriers on their own losses is highly informative and sobering. Coalition, a leading cyber insurer for small businesses, reported in their 2023 cyber claim report, for all causes of loss, the average loss payment was $197,000. Now, unlike in the Hiscox report, Coalition reported ransomware, their leading loss, with an average extortion demand, and this is huge, $1.8 million. I remember years ago where these were like 1,000, 5,000. We were shocked if there were over 20,000. Now, look, 1.8 million. And Coalition said the average payment they were able to negotiate down was to $303,000, which is still a lot of money. Now, Coalition's second leading cause of loss, funds transfer fraud, the average payment was an astounding $199,000, with the highest percentage of firms attacked reporting under $25 million in gross revenue. Hiscox reported in their cyber survey, 1 of 8 of all firms paid out more than $250,000 per claim. Now, given the size of these loss payments, most small businesses would not be able to pay these amounts and continue in business. In fact, in one claim study, it was found that over 50% of small businesses did not survive a cyber attack. So maintaining a cyber insurance policy is an important consideration. Now, a further reason for purchasing cyber is loss prevention and mitigation. Many cyber carriers offering coverage provide extremely detailed loss prevention recommendations after conducting vulnerability scans as part of their underwriting process. Now, these scans look inward to identify and review a company's internet-facing assets and look for weaknesses, such as unpatched software, stolen information on the dark web, open RDP ports. We get alerts all the time that they find these are being opened, and other significant vulnerabilities. It's like hiring someone to stop by your house and look for unlocked doors or open windows. Now, some firms offer insureds on day one of a policy's inception, 24/7 active threat intelligence security scanning services to alert of any newly found vulnerabilities or specific threat actors. And when something is found, they alert their insureds immediately with suggestions for actions to take. I usually get copied in on these for all the clients I have, and they go directly to our insureds, and I get a copy as well. And so they're really frequent. And guess what? These alerts should be taken seriously and not as some sort of critique of an insured's IT security personnel. These are valuable pieces of information. Now, some insureds also provide free or heavily discounted managed risk solutions for buyers of insurance, such as multi-factor authentication, endpoint protection, and other security tools. A few even offer virtual CISOs to assist with any ongoing security questions. As previously noted, the number one reason cyber criminals attack small business is because of poor cybersecurity. And the number one vector of attack are phishing emails, typically resulting in ransomware or funds transfer fraud. Now, with respects to loss mitigation, the insurance carriers can provide significant benefits, which we will discuss when we review how to file a claim. And a further reason to purchase the coverage is it may be a contractual requirement. It's so routine for companies to require cyber insurance and include their clients as additional insureds. And a final reason is that, for many cyber events arise out of an attack against a third-party vendor hosting or storing an insured's data. Now, a loss or disclosure of a company's data by a third-party vendor does not relieve the original owner or collector of that data from data privacy laws. The data owner, not the data holder, is responsible for notification of the affected individuals of a cyber event involving their data. Okay, so how does an organization obtain coverage? Well, the first step is easy. Work with a local retail insurance agency like Pyramid Insurance, who can access carriers who provide non-binding indications by simply providing your address, nature of operations, year-end gross revenue, employee count, and loss history. However, okay, that's, they're going to go to what they call an API or an online system. They can plug that in. However, it's normally best to complete a longer form application in detail the existing cybersecurity measures in place for the agent to market, as this may result in better pricing. So basically, the more detail you provide, the better picture it provides the underwriters. Now, remember, they're doing these scans and they're going to look for vulnerabilities, but there's stuff they can't capture. So the better the information, the better the outcome. Now, please note, I think Al said this at the beginning, not all organizations will qualify for coverage. Now, depending on the nature of the business and the data they hold, that's a big key. So they look at the data, type of business, they say, you don't have MFA, you don't have endpoint detection and response, or you don't encrypt your offline backups. I'm sorry, we can't offer you coverage. And I get these in place, we can bind coverage. But until then, we can't do so. So we run into this all the time, that clients have to do a little bit of effort, upgrade their security, and then they suddenly become insurable. Now, by default, most small businesses purchase a $1 million annual aggregate limit for all coverages. Given the size of the typical ransomware payment and the cost of the forensic investigations can easily exceed $100,000, and I gave you some examples of that, higher limits should be considered, especially if the organization has a high number of confidential records at risk. And, limits of up to 10 million are available. Really large companies are buying limits of, 200, 400, 500 million. Now, cyber is rated off revenue, either the last 12 months or projected 12 months. And then with rating heavily figured in with the nature of the risk and the number of potential confidential records and the cybersecurity measures in place. Now, the good news is for really small businesses, pricing can start as low as $1,500. So how is a claim filed? All cyber carriers have a claims hotline staffed 24 hours a day. So if there is a mere suspicion, and this is very important, of a breach or other attack, it's imperative to contact that hotline ASAP, as well as let your agent know of the incident. Some insureds also send emails to the insurer's claim inbox, which is constantly monitored. So typically, these hotline personnel will assign a breach coach, basically quarterback, who will, within 24 hours or less, quarterback a mitigation response, which I described earlier in my discussion of the breach response coverages. Now, if the incident involves an extortion demand, the carrier will work with the insured to determine the best course of action and to assist them in the process of negotiating and paying the ransom in Bitcoin. In many cases, the insurance carrier might recognize who the cyber gang is, and they might have some insight whether or not, do they actually destroy the data? Do they exfiltrate to the data? Do they give your data back? Anyway, so if it's a funds transfer loss, okay, the carrier will work with the insured's financial institution. Now, this has to be done almost immediately to see if the payment can be stopped or mitigated to reduce the loss. And then lastly, of course, if anything generates to the point of a lawsuit, the carrier will hire an attorney to provide defense. So with respect to business income or reputational losses, as well as any type of cybercrime losses, the insured is going to have to put together what is known as a proof of loss. Now, this usually involves hiring a forensic accounting firm to assist the insured in quantifying the dollar amount. And most insurers will pay for these forensic accounting firms' assistance. Now, this is one area, though, there may be profound disagreement with the carrier in terms of what qualifies as a loss, and it can take considerable amount of time to work out an agreement with the insurance company. So, to recap, as we have reviewed the policy, it is certainly a radically complex insurance policy covering first and third-party losses, including breach response, loss of business income, PCI or contractual related damages, media liability, regulatory fines or penalties, and damage to hardware, as well as crime. The policy responds to both oops, mistakes made by employees, including the loss of data in paper form, as well as the malicious attacks of cyber criminals, as well as responding when a third party in possession of an insured's data is responsible for a breach of loss of business income. The coverage provides asset protection for the insured to financially respond to these attacks and pay any resulting losses, which can be extremely expensive and are crippling for smaller organizations. Finally, it provides immediate access to experts. Little history here. In the early 1700s, the origin of a few insurance companies started with the creation of local fire brigades. For example, in the city of London, property owners would pay a small premium to an insurance company to ensure their fire brigade would respond to a fire at their property. Now, this was evidenced by what they call a fire mark, a big sign that was put on the outside of the buyer's property, particular to that insurance company. So when the fire crews came rushing over, they could see the fire mark and know that they had paid a premium. And if they didn't have secured the property insurance, they wouldn't put out the fire. So, as it was then, it is now with cyber insurance. The insurance companies have contracted not with fire brigades, but with mitigation firms to provide the experts like ransomware negotiators, forensic investigators, law firms specializing in privacy laws, fulfillment and credit monitoring firms, and more to respond immediately on behalf of an insured in the wake of a cyber attack, providing peace of mind for smaller organizations that their claim is managed by industry experts devoted to responding to a cyber attack. Now, ask yourself the question, how many companies know exactly what to do if they experience a data breach or ransomware attack? Do you? Who are you going to call? What prices are you going to have to pay for an emergency response? The insurance companies have removed most of this uncertainty. Now, these losses can be complex, radically complex, and it takes a radically complex policy to respond. Okay, that is my presentation. So let's move on to questions.
Nathan, do we have any questions in the chat window?
I see a question here. Can the cyber policy respond if the website is not ADA compliant? Okay, no, the cyber policy doesn't respond to that. There is a policy that does. That's employment practices liability policy that has coverage to extends coverage for what we call third party liability. So that covers any form of discrimination or harassment of a third party. So if you've got a website, it's not ADA compliant, and they allege that you've discriminated against the disabled, that third party coverage and an employment practices liability should provide coverage. We've seen a number of claims cover that. I mean, policies cover that exposure.
Do we have any other questions? Let's see, I think. Okay, so we got another that came in. Are there generally requirements for cybersecurity to be in place prior to issuing a policy? Are these requirements per insurer?
Okay, in general, most of the carriers are requiring multi-factor authentication to be in place. There was a big push a couple of years ago by the carriers to get this done. And almost every carrier is requiring it prior to the purchase of the coverage. In the last 12 months, we've seen the market slip backwards. And so there are a number of carriers that will waive this requirement. There are also a couple of carriers that will provide assistance getting people set up on MFA. I think one of the markets provides, it's a software system called Duo to get people established in this area. Another area that's been required has been the requirement that endpoint detection and response is in place. Now, this is an endpoint is any access to the computer network or to your computer network. That could be laptops, it could be cell phones. So all this needs to be protected with an endpoint detection type software system, which basically looks for any nefarious individual trying to penetrate at various endpoints into the network. And then couple of the other ones, some of the markets require prior to binding that an anti-phishing program be established, or offline encrypted backups are in place. More questions?
I think we have one more that we're pretty much at the end of the hour, but to what level of detail is required of the current cybersecurity standards / practices within the company when applying for coverage?
What level of detail? Well, it's really funny because it's all over the map. The insurance industry is a little strange this way. If we go on to some of their online websites to get, we can actually apply for coverage, get quotes online. The level of detail sometimes is just minimal. I can think of one market, CFC has a portal, an online rating portal, and I just have to put in like name, address, confirmation there's been no claims, and projected 12-month revenue and employees. Pretty basic. Other markets really do ask the questions. Do you have MFA? Do you have EDR? Tell us about your backup procedures. Tell us, do you require callbacks for for wire transfer requests? So it really can vary carrier by carrier. So I'll just leave it at that.
Okay, sounds good. And then two more questions. Does the policy pay out if it is found that there is a fault of the company's cyber practices / policies rather than a human error?
No, it'll stay payout. I mean, it'll still pay out. It's that's really kind of what network security is. And your network security doesn't really meet certain industry standards, or the company thought they had patched all their software, and later it's found, they represented they had, and they found out that there was a legacy system that wasn't patched. So the policies are pretty generous about that. I mean, when you're answering these questions, you're trying to do your utmost in good faith to answer these questions accurately. And of course, there are things that no human individual could actually answer every single aspect of on an application. I mean, to fully represent a company, because there can be so many moving parts.
Okay, sounds good. Another question is, do you know why it is so difficult to retrieve or retract funds that were transferred due to cyber attack via ACH/EFT? Is the government doing something to help with this?
Oh, that's a great question. I frankly have not had that question before, and I don't know that government is doing anything about this right now. Um, when you talk to certain insurance companies, if they can contact the financial institution quickly, sometimes these transactions have a bit of delay, and they are able to get in and mitigate and maybe put a stop before all the funds are gone. But there's other cases where there's nothing they can do. It goes quickly. So it's a bit of crapshoot, really, what's going to happen there. But in the most cases, the monies are long gone. So if there's any way a company that has this insurance coverage, if they find out about it, within the hour, there might be something that could be done, because maybe the delay might be much longer than that. So it's all about timing. But I have no idea what the government's doing to help in this area.
Okay, very good. Two more questions. Is there coverage to cover tech OEM hardware or software that are found to contain embedded hardware/software? I assume the question is either vulnerabilities or malware.
Okay, let's jump back here. We can cover systems restoration, which is restoring the data, or trying to restore maybe software, get it fixed. Okay, there's generally no replacement. Well, there's actually no coverage for upgrades over what they already had. Okay, some of the policies cover what they call, I didn't go into this because we only had an hour, what they call betterment coverage, which gives a small sublimit to upgrade the software. So 3.1, now it's on 4.2, and the old software was compromised by the attack. And so with the betterment coverage, they can upgrade. It's possible that the insurance carrier might make what they call an ex gratia payment if it's just not feasible to get to really repair the old software. And that's where we get into bricking coverage, which really applies more to the hardware. So the particular cyber, the malware is so virulent that it actually damages the equipment, so it's useless. I remember, maybe some of you remember, there was the attack that affected Maersk, the big shipping company, a couple of years ago, and I heard they had over like 1,000 laptops that were affected by this malware attack, and those laptops were worthless. So, but I don't know how the insurance company covered that claim, but I just know that was an example of bricking, where the hardware, the laptops were worthless. That was called I think it was called the Not Getcha attack.
Very good. And then the last question we have is, are the requirements higher as the coverage goes up?
Well, in terms of limits, that's another great question. If a company's going to put up, they're probably, in some cases, I haven't really thought about that. To get maybe a $5 million limit, a market might say, well, we're going to give you 2, but if we're going to go to 5, we're going to want to see these new things added. Okay, you're going to have to, start an anti-phishing campaign, or you're going to have to, update this or that. So that's a great question. So yeah, great question.
Very good. So those are some excellent questions. We are running a little over, but I do want to turn it back over to Tammy to help close this out. Thank you, Mark. Tammy?
Yeah. Thank you, Mark, for such an in-depth look of many ways cyber attacks can cause profound impact on our businesses. As Mark mentioned, Pyramid is a retail agency that can help find cyber policies that best fit your needs. We're a 37-year-old local agency that has become one of Hawaii's most prominent insurance agencies, with a commitment to excellence and a deep understanding of the unique insurance needs of our local businesses. We provide tailored solutions to ensure financial security for our clients, with multiple locations across the state and a team of experienced agents dedicated to finding the best coverage options available. So Mark has mentioned, please contact us at the email and phone number listed on the slide with what we need to obtain a cyber quote tailored to your specific business requirements. Our team of experienced agents provides personalized solutions that align with your unique needs. We are committed to delivering exceptional services and ensure that we pair you with an agent who has the expert to support your business objectives. Thank you, and thank you for your participation, and I look forward to hearing from you.
Thank you, Tammy. So that concludes our webinar for today. I'd like to thank Mark and Tammy for sharing their insights, and I hope all of you got a good practical set of information out of the presentation today. I think there was quite a bit of information and detail in the presentation, so I'm going to encourage folks to go and take a look at the recording once we post it to our website in a couple days, and you'll receive an email letting you know when it's been posted. Update, our next event is a cybersecurity mentorship, which will focus on mentoring and internships to encourage cybersecurity workforce growth. That'll be next Tuesday at 2 p.m. and it's an online presentation. It's supported by CISA, Servco, and ourselves, CyberHawaii. So with that, I'm going to call an end to our webinar today. I want to thank you folks for attending and for sticking around. I know we ran a little over, but I hope everyone has a great rest of the day. And thank you very much. Mahalo. Take care.
Thank you.